Live from Sydney, I'm Paul Allen, and this is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. And Micron, reigniting the AI trade, lifting Asian stocks and US futures after a blockbuster sales outlook crushes expectations. A sharp drop in oil, raising wartime gains. That's also easing pressure on stocks as markets latch on to rising supply and calmer Iran headlines. The dollar hits a 7-month high, piling pressure on Asian currencies. We'll discuss how softer oil and the Fed's favourite inflation gauge are shaping yields and risk. The rupiah's slide is raising questions about investor confidence as policy risks build. Indonesian Chamber of Commerce and Industry Chairman Anindya Bakrie joins us to discuss what's at stake. Our top story today, the AI cheer spreading across Asia with stocks rallying alongside US equity futures. And this comes after Micron's blowout sales outlook reignited confidence in the artificial intelligence trade, with a slide in oil prices further boosting sentiment. South Korea's SK Hynix, among the big gainers, and this is after it unveiled plans for a $29 billion US listing. For more, let's get to Asia equities reporter Sang-Mi Cha. Sang-Mi, a huge announcement from SK Hynix today. What are the expectations around investor appetite for this?
Paul, we've been waiting for this announcement, actually, and it's going to start trading from July 10th. And the major appetite from the investors is that they get accessibility, in the other market. SK Hynix has always been considered as this commodity stock, commodity DRAM stock that just is in Korea. So it was very difficult for investors to draw parallels to Micron and SanDisk and so other memory makers in the U.S. So now the investors are thinking that this will definitely help narrow the discount in its valuations. We're looking at about 7.5 times forward earnings for SK Hynix, and for Micron, we're looking about 9.3. So there is still a little bit of that catch-up play that these stocks can play, and so that would actually help further boost the SK Hynix stocks in Korea as well.
So what's the plan for the money that SK Hynix is going to raise by doing this?
Well, the company says that they're going to be mainly using the proceeds to fund and expand their capacity. We're talking about the shortfall in high bandwidth memory and all the memory chips across the board. Some reports say until 2028, but there is still really not a precise number here because there is so much of that shortage to really power these AI demand. And so that will be the main use of these proceeds. But at the same time, they're also looking at buying a lot of these ultraviolet lithographic machines to, again, build some of the more advanced chips. Again, SK Hynix does hold a dominance in high bandwidth memory. It has about 58% in its market share when it comes to the revenues. So this is where their edge is in right now.
Well, in terms of the stock, we're seeing it put on another day of phenomenal gains, up almost 12% at the moment, and nearly quadrupled, of course, this year, or something like quadrupled. It's been an incredible run. What are analysts saying about where the price is this time next year, or say in 5 years?
That's a good question. We have definitely reported about SK Hynix entering the $1 trillion market earlier, and it's actually catching up to the market cap of Samsung Electronics. And again, this is also coming at this juncture when the choke point of the AI demand globally is really pointing to these three stocks, SK Hynix, Samsung, and Micron. And investors are saying that the listing will definitely help narrow not just valuation, but again, further boost the SK Hynix's stocks. What they are expecting is a catch-up play to the other global peers. Philadelphia's semiconductor index is trading at over 22 times forward earnings. So there's a lot of gaps there that they can catch up on. And again, the capacity they can build in Korea will add to more of these gains that the company can imagine.
All All right, that's Asia Equities reporter Sang-Mi Cha there. Well, the entire supply chain for semiconductors is trading strongly across the region as Micron's high margin guidance makes the case for a lasting supply crunch. Memory names, semi-equipment and chip materials all making gains. For more on the implications of this, let's get to markets reporter Anthony Stevens now. So, Anthony, let's start with those Micron results. What are they telling us about the sustainability of AI capex and, of course, the read-through that we're seeing into Asian markets?
Well, the guidance signal for the fourth quarter is very strong, right? They're guiding in and around 85% margins. Now, that speaks to a structural shortage of memory. You don't get to charge 85% margins for a commodity product, and that is buoying expectations across the supply chain that, there's a shortage of materials, there's a shortage of equipment, and there's a shortage of just pure capacity. And as Sang-Mi was alluding to earlier, the fact that SK Hynix can raise such a large amount of money and see the stock trade up speaks to investor optimism that that money will be deployed in Korea to build out that capacity as quickly as possible. And that is buoying the entire semi-supply chain. So you're seeing in Japan, in Korea, in Taiwan, anything to do with enabling the growth of this capacity. So in terms of semi-equipment or semiconductor materials, these names are on fire today, and that's been very sustainable. If you think about what's been the best performing stocks in Asia, on the tech space, it's actually been some of these bottleneck plays in Taiwan, in Japan, that are up 200% plus.
So, such strong investment in AI, it obviously also raises the risk of inflation. Core PCEs on watch tonight. How's this shaping up for the dollar trade?
Right, this flood of investment is going to increase wages. You've seen that in Korea, and it's only logical to assume that it's flowing through in the US. You're seeing a uptick in construction, in power equipment, in even power generation, modular, nuclear, and all these kind of things. All these things at the margin are inflationary. They're inflationary on the core front, in the core PCE front. When you look at wages, when you look at power costs, when you look at construction costs, these are key indicators that the Fed will be looking at, because the Fed under Wash is very focused on core PCE, not on the transitory stuff with regards to oil or food. So today's number is going to be very interesting. Core PCE has been trending higher now for a couple of prints in a row, and the dollar has been rallying alongside. So that's going to be a very interesting. The dollar is on the brink of a breakout. It's almost broken out against the yen. It's already broken out against gold and the euro. So this is something that is going to be much more macro from the micro of the tech trade.
Yeah, to your point on gold, now through 4,000 with 3,975. Bitcoin perilously close to having a 5 handle now. So can we say dollar debasement's dead as a concept?
Look, it's interesting that the riskier ways to play a weak dollar have got decimated in this sense, right? It was a retail trade on the way up. You saw those sharp rallies in Bitcoin and in gold and in silver at the height of the euphoria at the start of this year, and those trades have gotten aggressively pared back for two reasons. One is that the dollar is very strong. The second reason is obviously that retail has other things to do. They can play this semiconductor trade quite aggressively. Micron trades $60 billion a day. So you don't really need to be playing gold or silver, which have less fundamental support with the dollar being strong. So in terms of debasement trades, the debasement trades that are very dependent on retail flows, those are going to struggle until and unless there is a change in the dollar trajectory. In terms of the diversification away from the dollar into the yuan or the euro, those are much more fundamentally driven. The yuan trade seems to be steadily more in place as China looks to open up its capital markets, but Europe is really struggling in terms of energy shock and an export slowdown. So it will be very interesting to see how that trade kind of develops over time.
All right, Bloomberg Markets reporter Anthony Stevens there. Thank you. Well, joining us now is Teck Leng Tan, Executive Director and APAC FX and Macro Strategist at UBS Wealth Management. And Teck, you have previously advised clients to sell dollar rallies and diversify. Do you stand by that position?
Hi, Paul. Thanks for having me. I think in the near term, we do acknowledge that the dollar still is being supported by very strong momentum. The Fed is hawkish. So I think in the near term, we would not dismiss the fact that the dollar can stay stronger for longer. But I think to your point about whether we still encourage clients and investors to diversify away from the dollar, I think it is still an opportunity to be using the current levels of the dollar strength to diversify exposure out of the US dollar on a more medium to longer term basis. I think the pivot point for the dollar strength to really roll over, even though we have to be patient to wait for the turnaround in the Fed language, but it actually should be visible closer to the 3 to 6 months mark when the core PCE and the inflation pressure actually rolls over. I think the current market pricing for the Fed to hike rates by close to 2 hikes is actually looking mispriced to us.
Yeah, I wanted to pick up on that point because that is something of a contrarian view. Do you feel that the Fed might not necessarily lift rates in 2026?
That is our view, because we don't think that there is actually a pretty high hurdle to raise rates. I think if we take for reference what the dot plot has shown us, even though Kevin Walsh himself did not plug in his own dot, but I think you can actually get a sense how finely balanced the debate is between either keeping rates on hold as they are and just hiking once, just to keep inflation expectations under control. So I think to that degree, even one hike is already very closely debated within the FOMC members itself, let alone the 2 hikes that the market is looking for. And I think to a certain degree, if you look at the break-evens, the inflation expectations that is implied by the break-evens, very thankfully, the 1-year break-even is already trading at about 1.5%, lowest it has been in about a year. The 2 to 5 year break-evens is also very well under control, about 2 to 2.2%. So I think there is definitely merit to be keeping a hawkish bias just to keep inflation expectations under control. But as oil prices roll over, I think the need to hike rates would actually dissipate.
Yeah, let's talk about some of the currencies on the other side of that dollar trade. And I want to start with the yen if I can. I mean, we're hovering around that low that we haven't seen since the end of 1986. What are your expectations around the potential for intervention and the effectiveness of even doing this anymore?
So I think for every passing day that the dollar yen hovers at the current level, it kind of brings to question what is the real sensitivity or threshold of the Ministry of Finance. So if you were to look back to 2024, the dollar yen hovered above 160 for as long as about 12 to 13 trading days. So I think at this point in time, we are about a week and a half above the comfort level. I wouldn't be dismissive of the fact that this is actually not a sensitive level anymore. I can also see the possibility that, for example, into next week's holiday shortened week in the US, where liquidity is getting thinner, it could well be the case that we could get another round of intervention. Whether it is sustainable, history has shown that it hasn't, but the move can actually be pretty painful because for the last few instances where they intervened close to 160, the dollar yen actually fell about 5 to 6 big figures down in a couple of days.
Is it your view that tightening from the Bank of Japan is the only realistic path to yen strength? And with that in mind, how do you see the Bank of Japan acting for the rest of 2026? And do you have a price target for the yen for the end of this year?
No, I wouldn't say that the BOJ hiking rates would be the solution to stemming yen weakness, because I think what investors has realized that is that Bank of Japan tends to be still very conservative. As far as the approach is concerned, they tend to be a little bit behind the curve. So I don't think they are the main driver of turning the dollar yen around. I think what we need for the dollar yen to stabilize and roll over is actually a repricing from the Fed side. So when the market goes back to pricing in no hikes, potentially even an easing bias over the next 12 months, I think that would actually matter more for the dollar yen than the BOJ hiking per se.
Well, we've seen a lot of EM currencies getting crushed by the Fed's hawkish stance. Now, if you're of the view that the Fed is not, in fact, going to lift rates, which EM currencies do you think have the most upside going forward?
Well, I think within Asia, we would still be sticking to the more stable currencies. So not necessarily those that have been hurt the most from the repricing of the Fed, because if you go in that direction, you would certainly think that the likes of the Philippine peso, Thai baht, they could actually see a bit of a relief rebound if the Fed pricing gets out of the pricing curve. But I think bearing in mind that in the near term, there could actually be a bit of a stronger for longer dollar complex, I would actually stick to the safer bets within Asia, and that is to the likes of the Chinese yuan, which has a very clear policy guidance towards gradual strength. It is the only currency within Asia that is still holding up over a 3-month basis. I will also think that the Australian dollar offers value at the current level, and the Sing dollar as well is a steady pair of hands, because we do expect the MAS to continue with its hawkish bias later this year. So for now, stick to the safer bets, which is the Chinese yuan, Sing dollar, and the Australian dollar within APEC.
In terms of the Chinese yuan, is there a difference between rhetoric and the actual benefits of weakness? The PBOC seems quietly comfortable with having a weaker yuan to offset some of the structural weakness that we're seeing.
Well, I think there is a balance between too much strength being unhelpful. You're right to point out that I think given the domestic weakness of certain parts of the economy, having good exports is not necessarily an unwelcome phenomenon. So I think there is a balance to how fast it can strengthen. But at the same time, I think what is driving the Chinese yuan stronger is not necessarily the officials trying to pull it stronger. The officials is actually quietly allowing the natural forces to gravitate towards a lower dollar Chinese yuan exchange rate. If you look at the conversions by the Chinese exporters and corporates on a monthly basis into local currency, conversion from the dollar proceeds into local currency, we are having a run rate of about 50 billion. So I think what is happening is that the confidence around the export resilience is actually encouraging exporters to be converting into local currency, and the Chinese yuan is actually just being allowed to follow in terms of the central bank fixing mechanism.
I'm wondering if you have a view on the Taiwan dollar as well, because we're getting some extraordinary numbers from Taiwan. GDP growth forecasts approaching 10%, massive AI server exports as well. Why is this tech boom not translating into currency strength?
I would say that the currency resilience is a little bit masked by the fact that the dollar is strong. Because on a relative perspective, the Taiwan dollar is an average performer. It is not an underperformer within an APEC context. Over the last 3 months, it is down by about 3.5%, which is in line with the average. Now, I think the difference is that as far as the strong dollar is concerned, it is keeping a lot of this very powerful trade surplus from translating into currency strength to the likes of the Taiwan dollar and even the Korean won. But the Korean won does have another issue to deal with, which is the single stock concentration rebalancing. That is not so much apparent in the Taiwan dollar, because the way that TSMC has rallied is not as far as how the SK Hynix and Samsung has performed year to date. But the trade surplus is still very powerful. I would expect that to play out over time once we get past this period of short-term dollar resilience. And so over a 6 to 12 month basis, we feel comfortable that the Taiwan dollar can deliver about 3 to 4% upside once the dollar strength has faded out.
All right, Teck Leng Tan, Executive Director and APAC FX and Macro Strategist at UBS Wealth Management. Thanks so much for your time today. Still to come this hour, Anthropic is accusing Alibaba of using thousands of fake accounts to illicitly access its Claude AI model. We have details of that story next. This is Bloomberg. Welcome back. You're watching Insight. We are keeping an eye on shares of Alibaba. Bloomberg has learned that Anthropic is accusing the tech giant of using thousands of fake accounts to illicitly access its Claude AI model. Anthropic also says rivals, including Alibaba, may be trying to build chatbots cheaply through a technique known as adversarial distillation. For more on this, let's get to Bloomberg Intelligence senior analyst Robert Lea. So, Rob, can you tell us some more about what Anthropic is alleging, and do they have evidence?
Okay, so adversarial distillation, a phrase that really trips off the tongue. So for those who are less familiar with AI, what exactly does that mean? The best analogy is to consider an apprentice who's involved in maybe an old-fashioned trade, blacksmithing or whatever it may be. They've probably built their skills over 30, 40 years. They're an expert in everything. They know everything back to front. That's the equivalent of the frontier models. And so with this analogy, the student models don't need to learn everything that the master knows. They just need to know the bare essentials, and so that they can be put to work very quickly. This is essentially what Anthropic is accusing some Chinese companies, including Alibaba, of doing, that they're basically using or training up their own models using Anthropic as the master model in order to shortcut, in order to save costs, in order to accelerate their route to market. So there is no, aside from these allegations, and I should point out this is not the first time Anthropic has made such accusations. They made similar ones previously to Minimax and Moonshot AI. So there is no external evidence to back these up apart from what Anthropic has said at the moment. We haven't heard also, I should say, to be balanced, a response from Alibaba, but I would imagine they're going to refute what has been said.
Mm-hmm. Okay, so from your analysis, why do you think that this could ultimately lead to a full US ban on Chinese models?
I think, again, take a step back, that's the direction of travel at the moment, because, what was it, a week or two ago, we saw the US putting a ban on foreign access to Anthropic's frontier models, their latest models that have been launched. So, again, although it wasn't explained explicitly, that probably also is related to concerns about distillation. In addition to that, we've seen a number of Chinese companies add to a DoD blacklist and also the Department of Commerce list. So I'm not saying that a ban is imminent or entirely likely, but given global AI is a two-horse race between China and America, given the Chinese companies continue to rise up the rankings, I do think it's a real and realistic risk.
So if it is a realistic risk, which Chinese firms could be the most exposed to a full ban?
Okay, I think to state the obvious, it's the ones who are more reliant on foreign markets. So first of all, companies like Tencent and ByteDance, their businesses are more focused domestically with a lesser exposure on overseas, so therefore relatively they would be less exposed. But really, I think Alibaba's CEO went on the record, in fact, earlier this week, saying essentially, to paraphrase him, we're going all in on AI, not just from models, but from cloud computing and also on the chip side. And they have a big focus on overseas markets, as do firms like Jupu AI, which has really been making the headlines here in Hong Kong recently, and the likes of Minimax. And I'd also point out that they are currently they're using penetration pricing. They're effectively pricing their tokens at a loss, and therefore they're more exposed. Even if we don't see a ban coming through, rising token consumption will actually cause their losses, particularly at Jupu and Minimax, to rise. So this sector is not on a commercial footing as things stand at the moment, with a risk on a US ban potentially pulling the rug from under their feet.
All right, great insights there, Bloomberg Intelligence senior analyst Robert Lea. Still to come, the Kospi back on the upswing on Micron's blowout forecast and SK Hynix's plan for a $29 billion US listing. KB Financial Group's Peter Kim is going to join us next with his outlook. This is Bloomberg. Welcome back. You're watching Insight. The Carlyle Group's head of investment strategy says more interventionist politicians are likely to win office in the US midterms if the Fed doesn't do its job and ensure price stability. Jason Thomas also told us the conversation around artificial intelligence has been overly focused on the negatives.
I think the way that some of the executives at foundational AI labs have been talking has not been particularly helpful from a political perspective. You're talking about essentially taking all of the jobs, taking a large share of your electricity, taking some of your water, and then also building models that are so powerful that they introduce incalculable national and cybersecurity risks. Oh, and by the way, we're going to need $1 trillion of your savings annually to make all of this possible. So I think first and foremost, there's going to be a modulation in the way these topics are discussed to try to make the benefits more obvious. And I think that, as it relates to data centers, there are issues thinking about the potential taxation or just getting a dedicated revenue stream to some of these localities. But the construction jobs, electricians, plumbers, they're very, very positive spillovers. So I think there is a great story to tell. I think right now it's a question of how best to communicate that and how to change some of the language.
We still feel like we're some way out from the midterms, but it creeps up ever closer. And then you get results like we did in New York City with the primaries of candidates who are very much so of the same ilk as Mayor Mamdani of New York City.
In fact, President Trump has just posted about it.
Oh, yes, he has.
He says Mamdani pulled through 3 solid communists.
And says, congrats, Mr. Mayor. Again, I know a big topic of conversation, Jason, is the midterms. And I wonder if for investors, they should be preparing for this really big pull of center to gravity to the left. Obviously, New York City, one of the most liberal cities in the United States. But if that's what we should be expecting more when it comes to nationwide elections.
I think that this comes back to the discussion about affordability. It comes back to issues related to the fact that the consumer price level has increased by over 25% over the last 5 years. I think many people have wanted rate cuts, excited about rate cuts, hoping that base rates get below 3%. But I think that if central banks do not deliver price stability, this is the alternative that investors have to consider. That all of a sudden policymakers start to pursue policy initiatives related to intervention in markets, price controls, nationalizations in some cases, public competition for private sector businesses. That is almost inevitable if your central bank does not deliver price stability.
That's Carlyle's head of investment strategy, Jason Thomas, speaking to Bloomberg's Matt Miller and Danny Berger. Let's take a quick look at where markets stand. We've got mainland Chinese markets heading off to lunch. Japan coming back online. It's pretty much a risk-on day across the region. A couple of important tailwinds to tell you about. I mean, one is the oil price, which is pretty much back to where it was before the war started. And there is sign that the market might be moving back into oversupply. This is even as US stockpiles dip down to below 19 million barrels. And of course, the other big catalyst that we've been talking about today, those blowout Micron earnings, also SK Hynix announcing a listing for the US, plans for a $29 billion US listing, providing a huge tailwind for the Kospi, up 5.5%. Although that said, it's been a wild ride for the Kospi this week. We're still about 100 points shy or so where we were at the start of Monday morning. Right, let's get now to our next guest. Peter Kim is Global Investment Strategist at KB Financial Group. Peter, thanks so much for your time today. And as I alluded to there were a few concerns earlier this week about the strength of the global AI rally. And then we got the Micron earnings, SK Hynix's announcement today about its US listing plans. Confident to say that these concerns have been erased?
For now, I mean, the price movement on the whole sector has been so fierce. We are all scrambling to really get a quick gauge on exactly what the price expectation and what is embedded in the price. But certainly the Micron earnings is very, very consistent with our thesis that as much as it's been a fierce rally, it is backed by earnings and fundamentals, and the valuations are still reasonable.
To what degree can we say that this lesson has been reinforced when it comes to AI? Just buy the dips.
At some point, that game is going to be over. But I think the transfer of wealth coming from the cashed out hyperscalers putting these massive orders in, not only massive orders, but real earnings visibility that is providing for the semiconductor players is something that I don't think we've seen even during the TMT crisis.
Can you see a scenario where these hyperscalers eventually build out their own memory chips and cut out, the middlemen, as it were, in South Korea? Or are you looking for some other catalyst that might say to you, yeah, this rally's over?
Yeah, well, there's always going to be attempt to try to have the second, third, fourth players. I mean, we've seen Chinese catch up on technologies everywhere, much, much quicker than anyone expected. So we can never say it will never happen. However, the evolution of the semiconductors, how each cycle you have the leaders becoming stronger and the secondary players exit the industry is sort of the part of the semiconductor industry's law. So I do foresee at some point that the Hynix and Samsung, probably maybe Micron, could take up the very high margin, cutting edge part of the segment, whereas the other players will come in and take more the commodity end, which would be your mobile phones and your PCs. But even that would take 2-3 years because that's how long it takes for these capex to come online. As far as the AI, any warning signals, past the week, there's been some concerns about the funding of these AI hyperscalers and whether they will actually eventually make reasonable, sustainable earnings. I think that's still about a year or two away. So I do think that visibility that semiconductor producers have on their earnings is very, very compelling.
Specific to the SK Hynix announcement of the US listing, do you feel, well, on the surface, this is obviously a move to access a deeper pool of dollar liquidity, but at the same time, do you feel like it's a defensive play against US trade protectionism?
There might be a couple of steps further away. You can see that everyone in the AI space are hurriedly trying to raise money, and maybe it is a signal that they are concerned about the funding environment maybe a year or two away. But certainly in terms of protectionism, I do worry a little bit about that. You have three companies essentially cornering the entire AI chip market. I think maybe there would be some concerns of protectionism, but to put a barriers up for a scarce commodity whose prices are rising so fast, I think it's really securing the inventory rather than actually trying to make it into some sort of a nationalistic issue.
I know you've previously made a connection between the spike that we see in the VIX, the big run-up that we see in the Kospi as well, that this perhaps signals some investors are buying on the basis of fear of missing out. But when retail investors start behaving this way, that's usually a signal that we're getting near the top. Is that a fair assessment?
That's exactly what happened during TMT bubble. However, as I mentioned earlier, this is a very rare case of retail investors chasing a very handful of stocks whose balance sheets are very strong, backed by earnings, and whose orders are coming through with visibility of 1 or 2 years out. So in this case, as much as price action looks like it's a bubble, I do think that we probably maybe halfway through this cycle gives us plenty of leeway for the expectation to surpass eventually of the fundamentals.
Is there another threat to consider as well? And we perhaps had a taste of this earlier this year, and that is labour friction, industrial disputes. Is this something we might see more of at SK Hynix and Samsung?
Well, for this year, it's discussion's over, but they've already trying to establish some sort of a profit share scheme for next year and so forth. I think the concern is that other Korean companies might follow their leadership on the collective bargaining and to try to establish such a scheme, which would actually put a bit of a burden on the labor flexibility. And when you consider that the AI and important part of that AI transition would be that labor flexibility, and countries whose labor can be adaptable would be the one to win. And in Korea, it seems like they're going the other way. So that's definitely a concern. But again, the earnings in these companies are so powerful. For now, it's becoming a secondary consideration. When the cycle leaves the top, or maybe even in decline, I'm sure we'll have to talk about it a lot more seriously.
Peter, before we let you go, I'm going to ask you for 3 price targets. I'm wondering if you can give me a year-end target for the Kospi, one for SK Hynix, and one for Samsung as well.
Well, all 3 is essentially the same question, because those 2 sectors take up more than 50%. So I'll just finish with, I feel pretty comfortable with a Kospi target of 10,000. And that will probably mean that both Samsung and Hynix has a comfortable 30% upside from here.
All right, Peter Kim, Global Investment Strategist at KB Financial Group. Thanks so much for your analysis today. And we have more ahead as well. MSCI's decision to retain Indonesia as an emerging market does provide scope for a relief rally, but concerns do remain over structural challenges in its stock market. Indonesian Chamber of Commerce and Industry Chairman Anindya Bakrie is going to join us next. This is Bloomberg. Welcome back. You're watching Insights. Former president of Chinese tech giant Baidu says he's confident China's AI players can convert massive infrastructure spending into real returns. Tsinghua University Ya-Qin Zhang also told us how the shift to agentic AI will drive most token generation to so-called edge devices like cars, robots, and wearables.
Certainly we're moving from generative AI to agentic AI. And also, the whole token generation going to take place mostly in the future on the edge, on your devices, on the cars, on the robots, on the glasses, on your watches. I would expect in the future 80% of the tokens will be generated not from the hyperscalers, not from data center, but from the edges. So we see a huge revolution and transformation in how we manage and how we interact with devices. What I call the cognitive UI.
Can you separate the hype from the reality in things like Zhipu? Their latest model, GLM 5.2, is supposed to be, the expertise is in coding for agentic AI. They're talking about being sooner than anticipated on par with what Anthropic is doing and the like. But again, they're bleeding money, as a lot of these players are. So where do you separate the hype from reality?
Well, Zhipu is a great example of the China innovation in terms of very high efficiency and just like DeepSeek and flexible architecture and with the generative token which are as powerful as some of the frontier models. But right now AI is still in the infrastructure is still in the investment stage. In the next couple of years, it has to prove it's able to generate the real income. That is able to scale to other part of the economy. Obviously, that is a challenge, but I'm confident eventually we be able to prove this investment in infrastructure makes sense.
That's Tsinghua University Chair Professor Ya-Qin Zhang speaking with our Chief North Asia correspondent Stephen Engel. Let's take a look at Indonesian assets. This is a day after MSCI postponed its review of the market from late June to November. Our colleagues from the Markets Live team say MSCI's move indicates that a structural overhang remains. Let's get more from our senior Asia equities reporter Abhishek Vishnoi, joining us now from Singapore. So Abhishek, tell us more about MSCI deferring that decision and the implications for Indonesia's markets.
Well, the deferral has largely come on back of MSCI saying that yes, Indonesia has taken some steps to allay their concerns, but they need to be sustained and there needs to be an impact. So they are probably giving them more time. MSCI before this decision of deferral had flagged that there are still issues, especially related to transparency and coordinated behavior when it comes to trading, that is yet to be allayed. And on top of that, MSCI has already reduced the weighting technically by removing a lot of stocks from its Indonesian gauge. Now, what it means for Indonesian markets, I mean, it means different things to different investors. The active long-only ones or the hedge funds, they are still pairing their exposure, as you can see in the flows, because the decision has been deferred, but the problems still remain, and the pathway is there, but it's a long process. For example, India got its free float right or increased its free float over 5 to 10 years, and Indonesia itself has a pathway where they are saying that they'll be able to do it in 2 to 3 years. So it's yet to be seen. If you talk to passive investors, well, deferral means that the money is still looking to move out as and when the decision comes out, or can stay back as and when the decision comes out. There is a silver lining. The valuations are very, very cheap. So it has become a fertile ground in terms of pockets of opportunities for value hunters, especially in some banking stocks.
All right, so given the cheap valuations and the extent of the underperformance, there is some value, there is some value emerging in Indonesia. So why are investors, and foreign investors particularly, still bailing out?
Yeah, that's a good point. Valuations are at 2 to 3 standard deviations depending on the time period you look at. But if you look at the earnings growth or earnings revision, essentially, not growth, the only market in Asia which has seen negative or no upward revision in Asia is Indonesia. So the earnings outlook is still under pressure, and it's competing in the EM space with the likes of Korea, where earnings have been revised almost 100% higher this year, in line with the rally that Korea is saying. So there's a lot of competition out there, and on top of that, Indonesia doesn't have many AI stocks like India. So while valuations are cheap, there is no trigger for upside, and that's why it remains in a limbo in a way. And then structurally, if you look at it, this China-style sort of approach towards policy making, towards decisions getting centralized, the moves that we have seen, in terms of miners or the concerns that credit rating agencies have flagged. All this has sort of pointed towards a market where there are a lot of problems, and a China-style approach would mean China-style valuations as well. And unless there is a credible change in the approach, I think foreigners are more likely to pair exposure. It remains an underweight, but slowly, even that underweight is getting reduced. And I think it's right now about 50-60 basis points in EM and Asia benchmarks.
All right, Abhishek Bishnoi, our senior Asia equities reporter. Well, joining us now, we have Anindya Bakrie, chairman at the Indonesian Chamber of Commerce and Industries, also CEO of Bakrie and Brothers. Anindya, thank you so much for making time today. And you have just, of course, returned from WEF and Dalian. You represented Indonesia's business delegation there. What are your key takeaways and how they relate to Indonesia, and how much investor appetite there is right now?
First of all, thank you very much, Paul. Number one, yes, I just got back from Dalian. It's a very nice forum, a platform. Been joining World Economic Forum for about 15, 16 years, but this is my first time. And that's the reason for it, because I think the topic is interesting, innovation at scale, and the time is very much relevant. As you know, Indonesia and China has very strong relationship. We have about $200 billion worth of trade, this year, and also China plus Hong Kong are investing about $20 billion per year to Indonesia. So we see this opportunity to connect, to talk about both ideas, and to think about something that's very much relevant for emerging markets like us. So that's why I'm there, and I'm very happy to be back in Hong Kong as well to talk to the financial sector.
We were speaking to our reporter a moment ago about the MSCI postponing its review into Indonesian equities, waiting to see if these transparency measures are effective. In your view, is there a risk to waiting? Could we see a lot more foreign outflows while that decision gets made?
I think, Paul, this is really an opportunity for Indonesia to strengthen further the fundamentals and also the way it communicates about its fiscal policy. I think from the business community, we cannot agree more with the market asking Indonesia to evaluate. But let's look at the fundamentals in Indonesia. Indonesia in Q1 is growing 5.6%. In terms of economic growth, producing about 800,000 jobs, which is in line to go to 4 million this year. In addition to that, in the last 70 months, Indonesia has been surplus in terms of trading with its partners. So whether it is exporting to China or exporting to the US, Indonesia is gaining some momentum so that it will definitely help to strengthen its rupiah going forward. On FDI, I can also say that about $30 billion coming in Q1. We hope this will strengthen also the currency exposure, which of course help to calm the market. But yes, I think the fiscal space needs to also be disciplined, and I think the government is taking a lot of measures about that.
Yeah, the government is taking a lot of measures, but do you feel that's going to be enough to restore investor confidence?
Well, I think, the big transition that the current government is making is going from a natural resources-based economy to more human resource-based economy. So there is some transition that we need to be, ready with. But when we see in the corporate sector in Indonesia, we see that most of our members are investing. And also, Paul, I would like to mention that 92% of Indonesian businesses are small, medium enterprises, and the number is about 60 million. They are still investing about $1 million a year, on average, and that brings us to resilience domestically. Having said that, I agree that the focus of Indonesia should be how to trade more and how to attract more investments. And that's what we see the government and, of course, the private sector hoping.
All right, Anindya Bakrie, unfortunately we're out of time, but thanks so much for joining us today. Anindya Bakrie is chairman at the Indonesian Chamber of Commerce and Industry. Now, just before we go, we'll take a quick look at tomorrow's show. We'll discuss the outlook for markets with Polka Mishra, partner at Javelin Wealth Management. Also, as pre-orders open for Grand Theft Auto 6, we speak to an industry expert about what's being touted as the biggest video game release in history. But that is it for Insight. Horizons Middle East and Africa up next. Keep it here with us. This is Bloomberg.